Welcome to the Pirls Stock Market Commentary for market week ending Thursday, July 3rd, 2014. Market breadth. With this past week's market advance, our bull-bear point and figure ratio rose from 1.92 to 2.39, advancing strongly into bullish territory. The total count of securities in bullish or bearish patterns rose 2% to 2,166. The count of bearish stocks decreased 12%, while the count of stocks in bullish patterns increased 10%. The Pirls P&F Market Breadth Summary chart shows us a market now 7 consecutive weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking on Membership, and clicking Sign Up. For those who are interested, a free 2-week trial subscription is available. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 119 points for the 7th rise in 7 weeks. At a positive 317.79 points, it has risen above the November 2011 top and continues below all 7 other tops above plus 100 and above all 6 bottoms below minus 100 in the last 35 months. Market Gauge Volume Analysis. In this week's volume analysis, the Russell 2000 ended in neither accumulation nor distribution mode. In the last 2 weeks, it had 4 accumulation days and 1 distribution day. Of the other indexes, both the Diamonds Trust and the S&P 500 deposit receipts ended in accumulation mode. Accumulation days are counted when the index closes up one higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Russell 2000 also ended in neither accumulation nor distribution mode. Momentum. The CCI 20 daily continues above plus 100 outside the plus or minus 50 range for a valid zero-line reject long entry point. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend this week, while the daily CCI 20 began a Woody's uptrend about 5 weeks ago. The CCI 20 weekly now has 6 consecutive weeks above zero for a change to an uptrend. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Bullish, computer hardware has entered and leads the top 5. Disk drives has re-entered the top 5. Oil continues in the bottom 5. Semis has left the bottom 5. Bearish, gold and silver continues in the top 5. REITs has entered the bottom 5. Focus this week from www.zerohedge.com. Productivity can return if the central banks would give it a chance, based on the work of commodity king Andy Lee. Here are a few points from the article. Commodity king Andy Lee's, ex-UBS and current manager of ALM Macro, explains that today's declining global productivity is and was always a consequence of government policy of taxing productivity in favor of social transfers. The economy is in this dis-accumulative phase, which means the slowing productivity of recent years and declining productivity of last year will compound at an increasing pace unless the economy is allowed to restructure. The positive is that the present mess is of our own making, and that it can be reversed if we so choose. Growth is not being constrained by a technology frontier, but rather by the systematic misallocation of the factors of production that has been central to government and social philosophy. The system has to change. The issue is whether government and ultimately society can survive during the change, whether the public can unite behind a leadership that can implement tough decisions and allocate capital productively, or whether further sacrifice will be needed first, and how that sacrifice may come. And included in the article is a link to the PDF of Andy Lee's original work. Thank you for tuning in for this week's Sand to Pirls Stock Market Commentary. Hoping that you have had a happily celebratory 4th of July weekend. Wishing you a great week coming up, and wishing you true success.